First off, let's cover the basics. As a director of a limited company, you can pay yourself in two main ways: a salary and dividends. But how much should the salary be? Well, it's not as simple as just picking a number. You need to consider things like national insurance contributions, income tax, and how much profit your company is making. Generally speaking, you'll want to take a salary that is above the lower earnings limit, but below the threshold where you start paying national insurance. For the 2024 to 25 tax year, this sweet spot is £9,100 per year. Why? Because this amount allows you to qualify for state benefits like state pension without triggering any national insurance contributions. Clever, right? Understanding dividends. Now let's talk about dividends, a word that gets thrown around a lot. But what does it really mean for you? Dividends are payments that are made to shareholders from the company's profits after corporation tax has been deducted. As the director and often the main shareholder, you can decide when and how much to pay yourself in dividends. But remember, dividends are only payable if your company is making a profit. That's after all the expenses, including your salary, have to be covered. The great thing about dividends is they're taxed at a lower rate than salaries. For the 2024-25 tax year, the dividend allowance is £500, and any dividends above that are taxed at 8.75% for basic rate taxpayers, 33.75% for higher rate taxpayers, and 39.35% for additional rate taxpayers. So structuring your pay as a combination of a modest salary and dividends can be much more tax efficient than taking a higher salary alone. Balancing salary and dividends. But how do you strike the right balance? It's all about planning ahead. All you need to do is ensure your company's cash flow is healthy and that you are not leaving yourself short when it comes to taxes, other expenses, and future investments. For many, the optimal salary is to take a salary at the national insurance threshold and then top it up with dividends. This keeps your personal tax bill low while still getting the most out of your hard-earned money. Important considerations and planning ahead. Now, a quick word of caution. This strategy isn't a one-size-fits-all. Your personal circumstances, company performance, and future plans all play a role. And don't forget about all the other important expenses your company needs to cover, like corporation tax, VAT, and any employees you might have. It's essential to keep a clear view of your company's finances and ensure you're making informed decisions. Also remember that the tax laws and thresholds change regularly. What's optimal this year may not be next year. So it's crucial to stay updated or work with someone who can guide you through these changes. So why choose Crunch? Here at Crunch, we specialise in helping small business owners like you navigate these decisions. We've got a team of expert advisors ready to help you determine the best salary and dividend mix for your situation, and our easy-to-use software can calculate your most tax-efficient salary, and it allows you to pay yourself in dividends, all calculated in a flash. So there you have it, a quick guide to determining how much you should take as a salary from your limited company. I hope this has cleared up some of your questions and given you a better idea of how to pay yourself in the most tax efficient way. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you never miss out on these latest tips and advice. If you have any questions, get them in the comments and we'll answer them. However, if it's personal questions, then it's far better to go to crunch.co.uk and talk to one of the excellent advisors who will help you and keep your matters more discreet. Thanks so much for watching, and I'll see you in the next video.